You would have expected John to give an answer which is straightforward and not a politician answer, even though he comes from a lineage of politics. For those who don't know, his great-grandfather was President of the United States. His grandfather...
I had nothing to do with that.
His grandfather was a senator and known as Mr. Integrity. And of course his father, an academic. All academics have high level of integrity. And so John comes from two aspects. One, integrity, and second, the culture of service. You know, that's in his family. And he has a better understanding of policy making. To that end, you know, Sheila Bair and others in your book talks about where we are in regulation, you know, Frank Dodd Act and all other acts. Question often people have we done enough, number one? Are we there? Is system better today? And second question, and I'll quote, I just wrote down today as I was reading, that our FDIC chair talked about how we have the regulation, we just do not have the political will to enforce it. Can you comment on?
Okay, yes, I'd be glad to. Thank you. The book, I'm gonna say the first of all, the book is made up, those of you who have it, of contributions from about 21 different authors, and each of them address what I call a different stepping stone on the path to enlightened finance, which we can get to. And about half those stepping stones have to do with the blocking and tackling of regulatory reform. So the answer is, you know, post Dodd-Frank, post Basel III, have we done enough to fix the shortcomings in the infrastructure of financial regulation that created the excesses or allowed the excesses to build up that caused the last financial crisis? And the answer is no. Have we done too much? The answer is yes. We've done too much of some things, not enough of other things. The one thing that the Dodd-Frank did right, I believe, was that it didn't try to hardwire into legislation all the things that needed to be done. It gave to regulators, delegated to regulators, the responsibility for writing the rules of the road. And given the emotionality that was prevailing at that time, I mean, they were hanging, you know, financial effigies outside the Capitol, and that was the Sachs and the Shitty hearings in front of Carl Levin. I mean, the fact that we got a bill that was even reasonably constructive was, I think, good news. But it means that ever since, regulators have been toiling away at trying to implement the provisions of Dodd-Frank, and we're only halfway through implementing what's in that rule alone. Meanwhile, the financial services industry is evolving in front of our very eyes. There's business as usual regulatory rulemaking. What the DOL just did on fiduciary standard wasn't in any act. They just decided to do it, you know, post facto. Come along, let's do something significant in the ERISA world. So a lot of that is going on. We haven't finished doing what Congress and international regulators told us to do. The system's evolving, so more needs to be done. We've, as I said, done too much in some areas, not enough in other areas. And having said all of that, do I believe, and do others in the book believe, that the financial system is safer, sounder, and more secure than it was going into the crisis? I think it's unquestionably more secure. There are probably two or three things that have made it more secure. More robust capital levels and less leverage, number one. Probably you could attribute 80% of the increased stability, prospective stability of the system to that. Derivatives reform, central clearing and execution facilities to try to mitigate counterparty risk in the world of derivatives, another big contributor to more stable systems. But market structure reforms, which Mary Shapiro writes about, systemic risk related to the migration of risk out of regulated sectors of the financial system into unregulated sectors of the financial system, where activity and assets now exceed what they were going into the crisis. Supposedly, the Financial Stability Oversight Council has the ability to look into the shadow banking world and say excesses are building up in non-bank lending to subprime borrowers. We're going to focus on that and regulate it, but are they doing enough of that? Is the radar finely tuned enough? Is the policy response quick enough and flexible enough to do something about those excesses? We don't know yet. But all that is going on, and let's not forget, every day the financial system is more interconnected and more complicated than it was the previous day. Complexity and interconnectedness means anytime you have a shock to the system, the shock spreads faster, goes deeper, causes more potential instability than it did in a simpler, less connected system. And Nicholas Taleb has written about that. So we have to keep up with the financial system that's evolving. It's never going to be over. And I think we're better off than we were, but the job isn't done and it won't be done. And a number of the people in the book write about what needs to be done.